Welcome to DLL's Financing 101 with tips, tricks, and trends for you. Here's your host, Lauren Baingo.
Welcome. We are joined today by John Plantier, otherwise known as Johnny Finance.
Hey now.
Thank you for coming on.
Absolutely.
I wanted to bring you here to talk about some of the changes in the macro environment. I mean, the last couple of weeks we've had a Fed meeting and an increase in the rates. We've had some regional bank failures. We had a buyout. Today, I think I saw a very gloomy report from World Bank that the global growth rate is the lowest in 30 years. And I mean, there's a lot. There's a lot to unpack.
There is. And there were significant events over the last 3 weeks. And I got to say, Lauren, it was pretty comforting to have a weekend where it was more of let's understand what's going on as opposed to reacting as to world events and news events.
Well, let's be honest. You were watching March Madness, and you weren't dealing with news.
Darn right I was. And a heck of games had happened, by the way. So yeah.
See that bracket buster.
Oh, they all were busted by Friday evening. If anybody's bracket was still intact, you shouldn't be. You should be picking sports teams and sports bets.
Well, moving back, because I totally took us down the March Madness, but coming back. So, let's start with the Fed meeting, so they met last week. Tell me a little bit about what you expected going in and what happened.
Yeah, so if we go back to a couple of weeks prior, where early indications were they were going to increase 50 to 75 basis points, and then you had the Silicon Valley Bank situation and Signature, and they had to change course, and they changed course quickly. When then there was rumblings that it wasn't going to be any type of increase at the March 22nd meeting. And then the inflation report came out. And they were fortunate. I feel like the Federal Reserve almost got a lifeline there because the inflation report was positive, was lower than expected. And they made the decision to only increase by 25 basis points. Now that helped to offset this regional bank potential systemic issue. Yeah, talking about March Madness, this is definitely March Madness for sure. But the underlying issue is that inflation is still well and good, and there has to be some mechanism to get that under control. And what the Fed has at their disposal is to be able to increase rates. I do think the longer term outlook, though, is the federal bank did recognize that any type of rate increases, especially that fast over a very condensed period of time, there's collateral damage. And here is a perfect example with the regional banks being collateral damage to just significant increases over a short period of time. However, if you look at rates in general, right, over the last 100 years or so, we're actually about at the average as to what the last 100 years are. So I know that people are often saying, well, rates are so high now.
Well, they feel so high. I got to be honest. I think it's just the rate of the increase as opposed to the actual rate.
It's definitely how quickly they went up, which is, by the way, the fastest in history. But it's also the fastest in history and the most amount of inflation we've seen. And if it's not the history, it's the last 40 years, right? So you have this shock and awe impact here when it comes to rates. So then you have a situation like the systemic bank potential failure, and the Fed says, well, let's reevaluate the position, which is exactly what they did.
Now you have the Fed walking this fine line, right? So we've got the inflation on one side, we've got regional bank failures on the other. Let's talk a little bit about the regional bank failures because Let's start with what exactly is a regional bank? Is that the bank down the street? Is it,
Yeah, they're a little bit larger than, let's say, the bank down the street. Now, they could be the bank down the street, but
Depends
if you
on your
think about,
street?
Depends on your street, I guess. Wall Street, just kidding. So, but if you were to think about Silicon Valley Bank, which by assets was the 16th largest bank, um, the regional bank doesn't mean small. In fact, the best way to describe a regional bank is one that does not fit the systemically important bank, the SIBs. Now, the SIBs, systemically important banks, they're the ones that are deemed too big to fail. And that was a byproduct of 2008. And they said, hey, if these banks were to fail, it would
It would be
have
catastrophic.
catastrophic impact in the economic world, and we simply can't allow that to happen. A regional bank does not fit that mold, right?
Got
Now,
it.
it still would be catastrophic, just maybe not to that extent. Um, but that's more or less the definition of a regional bank.
Got it. So, I mean, the 16th largest bank, that's not a small bank.
It is not a small bank,
All
no.
right.
And so you had this issue where it's the 16th largest bank that collapsed. But what you also saw though is the the cause and effect of what people saw as a result of Silicon Valley Bank was, is my money safe at regional banks?
Sure.
And you can't blame them, right? The FDIC says, hey, we insure up to $250,000, but if you have any type of money north of that, there was this panic. And in this world that we live in now with social media, this panic went so widespread so quickly, where you have many, uh, whether it's personal finances or corporate finances, saying, hey, I want to make sure that my money is protected, and I'm going to put it in a bank that falls under that systemically important banks, those SIBs, and take them out of the regional banks because I don't want to have my money at risk, right? So that's one of the cause and effect issue of this whole Silicon Valley thing. So then you had the regional banks who rely on those deposits saying, well, hold on here. We need that money. We need that money in house. So, how are we going to attract investors? And how are we going to attract deposits? Well, the only way to do that is to increase the yield on those deposits, right? So now regional banks are looking at it and say, hey, for us to attract depositors, we have to be able to give back a higher rate.
Okay. But when you give back a higher rate, that money's got to come from somewhere.
It sure does. And where that comes from is in the byproduct of higher equipment lending, higher mortgage rates. They're going to be charging the consumers for any type of lending product out there. There's going to be an increase in the rate, right? And that's how they're going to cover the additional yield and deposits there.
Got it. So it's a bit circular, right? So they can raise the depository rates, but they're also going to raise the lending rates.
That's exactly how it's going to work.
Okay.
And they need to do that to essentially it's plain and simple to attract depositors. Otherwise, if they don't have deposits on hand, right? We've all seen the movie It's a Wonderful Life, and then you have a run on banks, and they simply can't pay out the money when people are asking for it. So that's why the deposits become so necessary for these banks to be successful.
Jeez, it's craziness, and this part, thankfully, does not apply to us. Correct?
That is correct. So our institution is a non-depository, right? Meaning we don't rely on the deposits for our funding.
Well, thank goodness. Thank
Thank
goodness.
goodness is that's an understatement there.
Well, so now we've got the Fed, we've got the banks. What's next? What should we be watching for? I mean, when are we going to have the next Johnny Finance unpack it all?
Well, as you've heard me say many a times, Lauren, you can't fight the Fed,
You
right?
can't fight the Fed.
And this situation becomes so fluid. And look, we try to stay away from predictions here, and it's tough to say even what the next move will be. But I do think that things will start to hopefully calm down. They've got the systemic bank situation under control. The regional banks realize what they need to do to attract depositors. So you could have a leveling out of the market from that perspective. And The other thing that you got to look at too is there's this issue of this feeling that rates are just incredibly high right now, and they feel incredibly high. But by historical measures, they're actually right on par as to where they were for the last 100 years. So the impact in the market and the behavior of the market was, wow, I had some really cheap money going back 3 years, 2.5 years, and now all of a sudden I have to pay a much bigger rate. But what that is that's the shock and awe impact. That's the shock and awe impact of just a short period of time going from very cheap money to expensive money. And expensive is with an asterisk because it's actually on level with where they were for the last 100 years.
Well, and
It,
at the end of the day, if I heard you correctly, cash is so king. I mean, it's even more king than it was 3 weeks ago.
you always want to have some cash on hand, but there's no better time than right now, especially considering the environment that we're in right now, where certain deposits can yield north of 3.5%, 4%, 4.5%. I mean, there are some crazy numbers right there as a result of the Fed continuing to increase rates and also regional banks trying to attract depositors. So if you think about that cash on hand can be sitting there idle and accruing a nice interest rate there. Why would you want to make a capital outlay uh, where that money could just make a return for you sitting in the bank account, right?
Well, but our customers still need equipment, right? So at the end of the day, they absolutely need equipment. And so if cash is on hand, what would you recommend?
You got to finance that with a payment plan. What you want to do if you're a savvy individual financially, right? You have to look at the fact that yes, you are paying an interest rate, but you're able to yield a significant return on your money, which you weren't getting, by the way, 2 years ago, 3 years ago, where checking and savings deposits were yielding, next to nothing. Now you're getting a decent return. Why would you make a significant capital outlay versus financing the equipment, which you absolutely need? It's always better to look at and explore your financing options, and that's where we can help you with.
Awesome. And so our vendor partners, as they're heading out to see their customers, what would you suggest they do?
So first thing and first and foremost, get us involved early and often, and get our financing experts involved. Call you, Lauren.
Please
Uh,
do.
Call me. You could call
You could call
Variety.
us both. We're a lot of fun.
Call us both, and we'll invite you. We'll invite you on the podcast, right?
That's it.
That's it. And and just explore all your options, especially when it comes to financing. There's no better time than right now when, especially in this environment that we're dealing with, cash being at such a premium.
Yeah, I got to tell you, John, when I go out and talk to somebody, to me, hearing, this new equipment will cost you $3,500 per month is a lot less, what's the palpitations? Heart, it gives me less heart palpitations than, hearing, hey, we need $150,000 tomorrow. I don't know about you, but spreading that out and maybe you decide that you want the capital outlay, maybe you decide you want a different term, but at least it gives you a starting place.
Gives you a starting point, especially if your equipment is revenue generating. You're able to match your revenue with your expense. And that's the beauty of what financing does.
So tell me more about that. Why is that so key?
Yeah, so if you were making a significant capital outlay, and let's take that example of $150,000, right? So day one, you're out of pocket $150,000, which, following up on our previous statement, could be yielding 4% a year in a savings account.
Very nice savings account.
Very nice savings account. And you're making that capital outlay versus financing that piece of equipment, which could be generating revenue for you. Let's call it $5,000 a month, and your expense line was $3,500 a month for that example. So you're cash flow positive starting in month one, right? You take your revenue and minus your expenses there, and it's $1,500 that you're positive with. Whenever you're able to take that, take your cash flow right, and match your revenue with your expenses, your business will be healthier.
That makes sense. And if you have a delay, ramp up period for the revenue, we can also do deferrals and stuff like that, right?
We sure can. So let's say your piece of equipment, say, yeah, it's really exciting, but it's going to take me a few months to build up any type of patients that to bring in, and if there's reimbursements associated with it, there's going to be some ramp up period. So we can do deferrals, right? Meaning that you won't make your first payment, whether it's a 1 month deferral, 2 month, 3 month, in some very specific cases, 6 months, a variety of different structures to fit our customer's business plan. And that gives you the flexibility to say, you know what, I do want that equipment today, but you're not going to make a payment for a couple months here. And that also helps build up your revenue versus your expense line.
What if I wanted, what if your customer still wanted to make a payment, but maybe they weren't ready for the full 3,500? Is there an interim payment or something we could think about? Is there some creative way that we could do that? And I think you're going to have to also explain why I'm laughing at the creative.
I love the term creativity. It's my favorite term in all of financing is creative financing.
The sarcasm is oozing off of you right now.
And we absolutely can do that, right? So it's called a step-up payment, right? So that way we can also, if you wanted to make certain payments, you sure can, and it would ramp up to that monthly payment that you're comfortable with. But it gives you the period of time there where you have this ramp-up period there to allow your business to build up.
That's awesome. That's awesome. Well, and I think you need to close out before we're done and explain why creativity is not your favorite word.
Oh, so creativity, creative financing, right? So if I had $1, Lauren, for every time someone said, I want to have some creative financing solutions, let's just put I wouldn't be on this podcast, all right? Now, that was a joke, by the way.
I caught it. I'm sitting here laughing. I'm just waiting for you to explain this because I think at the end of the day, the answer is, we are creative. We're just answering questions.
At the end of the day, everything we do is creative, and we are just trying to we're doing a needs-based assessment for our customers to say, we can structure payment. Money is money, and the way you present money can vary and it can differ mightily, but at the end of the day, we're lending money. All we're doing is providing a solution by doing a needs-based assessment of our customers to be able to put the right product in front of them.
Yeah, one of the things I think that we do really well, or our team does really well, is work with our customers and our customers to find the solution that matches what they need.
That's exactly what we do, and that's where we're very, very talented, and we have a seasoned workforce here that can do just that. The one key to success is getting us involved early and often. And people, I often get asked, like, what are some of the best practices that you can engage with vendor relationships and rolling out it, whether it's a new program, existing program. Engagement early and often is by far and away the best practice that I can suggest to everyone out there.
That makes a lot of sense. You don't know what needs we're answering if you don't know what the needs are.
That's exactly it. And look, our vendor partners, they need to be the experts in their field. It's great to have some financing knowledge, but what's most critical is knowing when to call us and getting us involved. Phone a friend. Call us in, and we'll be able to have the financing conversation. That's what we're here to do.
Awesome. Thank you very much for jumping on. So much that we unpacked. I have no doubt, given the state of the economy today, that we'll have you back real soon.
I look forward to it.
Thank you for listening to DLL's Financing 101. Tune in next time for another exciting episode.